Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, if you have a SEP IRA, you need to watch this video because you're going to learn a lot about the SEP IRA, things that you probably aren't even aware of, and you're going to learn a lot about different options, including the solo 401k, which is an amazing retirement plan, and in many cases, far more robust and powerful retirement plan than the SEP IRA. So the reason I wanted to do today's video is just by chance. I was having lunch with a friend last week, and my friend has a SEP IRA, and he started asking me questions. I said, hey, do you know about the 3 to 5 rule? It's like, what are you talking about? I'm like, well, there's actually a SEP IRA rule that says if you have an employee or more employees that work for you more than 3 out of the last 5 years, you have to offer them benefits. So he responded, oh my God, I have an employee. She's been with me 4 years and I've been maxing out 25% my S Corp. I've never offered her benefits. No one ever told me. I said, exactly. By the way, have you ever heard about a solo 401k? No. Well, this is the reason and the catalyst for today's video. So there's millions and millions of businesses that have a SEP IRA, whether it's active or not active anymore, dormant potentially. And many of those folks would be very interested to learn that they can actually save more, borrow up to 50K, maximize Roth options, use leverage to buy real estate without triggering a UBIT tax, unrelated business income tax, gain better asset and credit protection simply by going solo. And that's part of today's video. So just some information about me. You guys know who I am. Written 8 books on self-directed retirement accounts. Actually, a 9th book is almost finished. I've been working on it for a couple of years. It's going to be called Mastering the Self-Directed IRA. And it's going to go in depth into a lot of very cool topics on self-directed IRA. So that should be released in the coming months, maybe sooner. Obviously, tax attorney, I have a master's in tax law. I worked at some of the largest law firms in the world. And for the last 15 years, I've been really helping educate folks on the power of self-directed retirement accounts. So before I jump into the SEP IRA, just obviously some info on general types of IRAs, right? Traditional IRA. IRAs were created in 1974 by ERISA. There's 65 million plus IRAs, over $13 trillion in retirement accounts. For most Americans, it's the greatest source of savings, whether it's personal or not, is locked into the IRA. The pre-tax traditional IRA is the most common type of IRA. You get a tax deduction for putting the money in. $7,000 or $8,000 if you're over 50 years old is the maximum. And once you pull the money out over 59.5, you pay tax, ordinary income tax. If you pull the money out prematurely before 59.5, it's tax plus a 10% penalty. Roth IRA, it's an after-tax account created in 1997. But once you're over 59.5 and the Roth's been open 5 years, all Roth distributions are tax-free. Then there's the SEP IRA, which is a profit-sharing plan that's adopted by a business, which is going to be the focus of today's video. And then ultimately the simple IRA, which I call the poor man's 401k. Works a lot like the 401k, but you can put away less money. So who can set up a simplified employer pension plan or a SEP? That's what a SEP is. It's called the simplified employer pension plan. Most people know it as a SEP. It's essentially can be set up by any business. It could be a sole proprietor, LLC, Corp, S Corp, C Corp, partnership. Doesn't matter. You just need to have a business. Any size of business, 1 or 1,000, although most cases, SEP IRAs are for small businesses, mostly because it's a pure profit sharing plan. And if you're the owner and you want to put away the maximum, which is up to 20%, if you're a sole proprietor or single member LLC, or 25% if you're W-2, up to a maximum of 69K in 2024. If you do 20 or 25% for yourself, you're going to do 20 or 25% for all your participants. So that's why once you have more than several employees, that's when a 401k will make more sense because you're going to be able to put away a good chunk of money. It's 23 or 30,500 if you're over 50 for 2024. And then the requirement from a business standpoint on how many or the extent of the contributions is smaller than a 25%, for example, profit sharing. It's very easy to establish. You basically, if you go into Fidelity, Vanguard, Schwab, or IRA Financial, you basically submit very basic paperwork, and the IRA is set up. The custodian, whether it's IRA Financial or Vanguard, will take care of all IRS reporting with respect to the SEP IRA. And with the SEP IRA, there's no filing requirements for the business vis-a-vis the SEP. The custodian is required to file the 5498 and all related 1099s for the SEP IRA. So as I mentioned, who could set up a SEP IRA? Generally, any business can. It's categorized by an employer contribution. So unlike a solo 401k or a 401k where you get employee deferrals, which is dollar for dollar, right? If you make $40,000, you can put away $20,000 dollar for dollar. It's not a percentage. It's literally dollar for dollar. SEP IRA is a pure profit sharing plan, meaning it's a percentage. Okay, and we're going to go through some of those numbers in a little bit more detail in several minutes. And essentially, the contributions are always vested once they're made. But these are employer contributions. So the business is making the contribution on behalf of the employee. So small example here, make $100,000 W-2 SEP IRA. The business will make up to a 25% profit sharing contribution. It could be 0, it could be 1%, it could be 7%, it could be 25%. And then that $25,000, if you use the 25% example, would be contributed by the business, tax deductible by the business on behalf of the participant, and it will be put in the participant's account, so to speak, and the money, however it's invested, will be invested that way. Now, the difference between a Vanguard SEP IRA and an IRA Financial SEP IRA, the Vanguard, it's basically a closed-end account, meaning you only can invest in what they offer, whether it's stocks or mutual funds, ETFs, and the like. The IRA Financial SEP IRA would let you do anything essentially that the IRS allows you to do. So, of course, you can do publicly traded securities, but you can also do non-publicly traded stuff, so long as it's not life insurance, collectibles like art, or any transaction that in any way directly or indirectly personally benefits the disqualified person, which is you personally, your lineal descendants, your parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons. Otherwise, you can do it. That's the advantage of the self-directed IRA. SEP IRA, you gain diversification, hedge against inflation, invest in assets you know and trust, whether it's real estate or investment funds or gold or cryptos, private business stock, you can do it. Let's talk about participation rules. It's pretty simple. Essentially, anyone that's over 21, and here's the thing, who's worked for the employer the last 3 of the last 5 years. This is the 3 to 5 year rule, which I'll get to in a slide, upcoming slide. But this is one rule that most people don't know about, okay? And this could be used as a shield or a sword, right? You can use this to protect yourself, meaning, hey, I just started this business. I have one employee. I'm not going to offer them benefits. I'm just going to max out my profit sharing because they haven't worked in the business 3 of the last 5 years, so I don't have to offer them benefits. They technically are not a participant in the SEP IRA. So that can help you as the owner maximize your contributions, but it also is a rule that must be followed. So take the example of my friend. He had no idea. So if his plan ever got audited, the IRS would say, hey, you failed to make the employer profit sharing contributions for your employee. And they would either make you make those up or potentially even invalidate yours. And that's probably what they would do. Generally would have a 3-year statute of limitation to catch you. But this 3 to 5 year rule is super important. It is not widely known. Most business owners that have a SEP IRA are not aware of it. That's because the institutions that give them the plan, whether it's the traditional institutions, I'm not going to name names, they don't probably know it themselves, at least the customer service reps. So they're not going to educate you about it. And that's not their job, right? That's the one important distinction with using a company like IRA Financial that specializes in IRAs, right? It's in our name, literally, versus a Fidelity or Schwab are more interested in selling you products. We're going to make sure that you are aware of all these rules so you can maximize your IRA plan and stay away from any IRS issues. Anyone over 21, and you have to have at least $750 in income, which obviously not a big deal. Okay, so who's exempted? Who does not count as someone that is a participant for SEP IRA contributions? So someone under 21, someone who's covered by a union, and any non-resident alien, right, who does not have U.S. wages. So you hire someone in Finland or something, you don't have to give them benefits. Okay, so the contributions that I mentioned prior, it's a pure profit sharing plan. There's no deferrals. So if you make 100K and you want to max out, if you're a sole proprietor, single member LC, Schedule C, the most you can do is 20% of your net Schedule C. If you are an S Corp, C Corp, it's 25% of your W-2. Just remember the 20% Schedule C, 25% W-2. It's a very complicated accounting reason why that is, but for purposes of simplicity, let's just stay on the basis of, trust me, this is the way it works. It's 20% of your Schedule C, 25% of W-2. So again, here's some simple examples. You make $40,000, you're a sole proprietor. The most you can put away is 20% of 40 or 8K. $40,000 SEP IRA contribution to an S Corp, 25% of 40 or 10K. There are no catch-ups. The most you can put away is $69,000 or $66,000 for 2023. If you're over 50 or under 50, this is your max. Solo 401k, we'll see in some future slides. There is a catch-up where you can go to 76.5 for 2024. So another reason we'll see why the Solo K is a far more popular plan for the SEP IRA. But the SEP IRA is out there. There's millions and millions of SEP IRAs out there. Before 2001, the EGTRA, the Economic Growth, Tax Relief, and Reconciliation Act, which was passed by President Bush after September 11, stimulate the economy. Before that act was passed, the SEP IRA and the 401k was essentially the same thing, right? It's like a KEO plan. It was just a profit sharing plan. No loan feature, no Roth options, no deferrals. So there was no reason to set up a 401k or a KEO. You might as well just set up the SEP, because with the SEP, the IRA custodian, IRA Financial, is responsible for all the reporting. With a 401k, you would be as the employer. So that's why the SEP IRA was just easier. CPAs and accountants just deferred to the SEP with good reason. After 2001, less and less incentive to go SEP, more and more reason to go Solo K, which we'll see in a couple minutes. As I mentioned, starting in 2023, thanks to the Secure Act 2.0, SEP IRA contributions can now be in pre-tax or Roth. Okay, pre-tax and Roth. In both cases, the employer will get a tax deduction for making that contribution. However, if the participant receives an employee deferral, a pre-tax employer contribution, pre-tax, no tax to the recipient. Why? Because they're going to pay tax when they pull the money out. If they receive a Roth contribution, they have to pay tax on that Roth contribution. Okay, and then it becomes after tax once they pay the tax. So if you have a SEP IRA and you're a Rother, you probably want to go to the Solo. But if you want to do a SEP and the company makes a $20,000 SEP contribution to you in Roth, you have to pay tax on the Roth contribution to make it after tax. Why? Because once you pull the money out after a Roth, 59.5, the Roth's been open at least 5 years, it would be tax-free. So the IRS has to tax that money at some point. Same distribution applies for SEPs and IRAs. Just a couple things here for SEP IRAs. It's up to you. You don't have to do it every year, right? You can skip years. There's no requirement. The U.S. retirement system is elective. It's not a forced system. Maybe it should be, but it's not. Essentially, if you make contributions for an eligible participant, you got to do it for all eligible participants. You can't just do it for yourself and no one else. That's why the 3 out of 5 year rule is so important. You got to keep that in mind, because if you have an employee that's worked for you 3 of the last 5 years, you're going to have to offer that participant benefits, which may determine or judge, exactly how much you want to make, right? So let's say you make 100K and your employee makes 40K, and you want to max out. You have a C Corp 25%. That's $25,000 for you, but you got to do $10,000 for your employee. So that may or may not change what you want to do. That's obviously may impact your cash flow, the business, but you will receive a deduction for those contributions. Contribution deadlines for SEP. It's a profit sharing plan. So you essentially can do the contribution up until you file the business return, including extension. So if it's a sole proprietor, single member LLC, it's April 15th, October 15th with extension. S Corp, March 15th, September 15th with extension. C Corp, April 15th, October 15th with extension. And this is for the 23 year, right? So obviously we're in 2024 today. If you're watching the video live, you could still set up a SEP IRA for 2023. You just make sure you haven't filed your final tax return, obviously including extension. Here's the 3 out of 5 year rule, which is just not widely known. And essentially, as I just want to state it again for clarity purposes, any employee that was in the plan that's worked for you 3 of the last 5 years, as long as they satisfied the other plan eligibility requirements, so they're over 21, they're not a union person, you got to offer them benefits, okay? This is the most restrictive eligibility requirement allowable. You can choose to be less restrictive. You could say, you know what? You just worked here a year. I don't care. I'm going to give you benefits. You can do that, but this is the most restrictive you can be. It's a very interesting, I don't want to call it weapon, but asset you can use, because for a solo 401k, or you don't have that. Once someone works 1,000 hours or 3 consecutive years of 500 hours or more, they're deemed a full-time employee and they're eligible for 401k benefits. There's no 3 out of 5 year rule. The SEP has it, which is a really cool little benefit that you can use positively for you to benefit you personally, your business, or your employees. You can use it as you see fit, but it is a nice little option. Essentially, for the 3 of the 5 year rule, any work, even if it's an hour a year, you have to count that towards the year of eligibility service. And as I mentioned, it's definitely the most misunderstood rule involving SEP IRAs. And it's probably gotten a lot of folks into trouble. And it's another reason why I do these videos, is to educate people into understanding how SEP IRAs work, some of the intricacies, the rules that you need to be aware of, and some of the benefits. Okay. And obviously, again, one of the biggest compliance areas, and people just kind of miss this up. So the pros on the SEP, why should you set up a SEP? Well, it's easy. The IRA custodian will do all the reporting. Okay. Super easy plan. You get flexible annual contributions. You can decide what you want to do. The 3 out of 5 year rule is very cool. You can use that to your benefit as a really good asset. You can set up the SEP in 24 for the 23 year, just so long as you haven't filed your final return. But the easiest part is the IRA custodian does all the reporting. You can have the flexibility to make contributions. And then I would say the 3 out of 5 year rule is a super, super big advantage. Disadvantage is the profit sharing. All you can do is profit sharing. There's no employee deferrals. And I'll go through some examples shortly. You don't have a loan feature. You don't have the ability to do mega backdoor Roth, for example. You are also limited in terms of the profit sharing, right? That's the biggie. And of course, there's no catch up, right? If you're over 50 years old, you're stuck at 69. If you had a solo K, you can go up to 76.5. So when you put it all together, you're going to see in a second the solo 401k. I mentioned since 2001, EGTRA, the solo 401k has surpassed the SEP IRA as the most popular retirement plan for the self-employed or small business owner, for the reasons I'm going to go into in detail shortly. A solo K, as the name suggests, really is designed for someone who's self-employed. The name solo 401k doesn't mean anything. You can call it an individual 401k, self-employed 401k, a uni 401k, an I 401k, an Atom 401k. I mean, it's just a name. The word solo 401k is not a legal term. You're not going to find it in the tax code. What a solo 401k means, and it's not a new plan, right? It was created when 401ks were created in 1974 by ERISA. But the EGTRA Act of 2001 gave it some very important features that helped it become so popular. I'll go through them, but just real quickly, it gave it employee deferrals. So you have employee deferrals and profit sharing. The loan feature, 50,000 or 50% of your account value, whatever's less. Roth options, right? So when you add all that together, you'll see in a minute why the solo 401k has become so popular. So add all that together, you'll see in a minute why the solo 401k has become so popular. So real quick, there's some eligibility requirements. Unlike a SEP, to be deemed a solo 401k, you have to have a business, number one, U.S. business. Number two, you cannot have any full-time employees that are non-owners and non-spouses of owners. So 1,000 hours or more, 3 consecutive years of 500 hours or more. Okay. If it's me and my spouse, even though my spouse, let's say I own 100% of the company, but I hired my spouse because she's smarter than me and someone needs to do the work. Even though she's an employee and not an owner, because she's my spouse, ERISA does not define her as an employee, and therefore we can still have a solo 401k, even though I have an employee that's non-owner. Okay, you can have a situation where you have a law firm, 5 partners, no full-time employees, kind of the lawyers just do all the work, you can set up a solo K, even though there's more than one owner. So remember, 1,000 hours or 3 consecutive years, 500 hours or more. Like a SEP IRA, any business can set up a sole proprietor, LLC, Corp, C Corp, partnership, even a charity. Just need to satisfy the eligibility requirements. If you do not satisfy the eligibility requirements because you have an employee, you could still set up a 401k. Okay, you just have to set up a regular 401k, like IRA Financial or Tesla or Facebook or Google, right? So that means generally you're going to potentially offer benefits to your employees. You're going to be able to contribute as an employee deferral $23,000 or $30,500 if you're over 50. And then a company would do a safe harbor match of between 3 and 5%, whether it's elective or non-elective. Elective means the employee has to put in money and then the company will match. So if the employee puts in 3%, the company will match the 3%. If the employee puts in 0, an elective safe harbor, the company will match 0. A non-elective is what we do. I think we're certainly very focused on making sure our employees have a very robust retirement plan. We just give everyone a non-elective 4%. So even if you put in 0, if you make 60K, we're just going to give you $2,400 of free money in your 401k. But hopefully we're encouraging people to also put in money so they can double up. Solo K, the biggest advantage is the amount you can put in. You can put in 69K if you're under 50 or 76.5 if you're over 50, but you're going to be able to reach that maximum amount much faster than with a SEP, right? SEP IRA is a pure profit sharing plan. So it's just 20% or 25% of your comp as a W-2. Simple example, you make 100K, sole proprietor, the most you can put away is 20K. With a solo 401k, if you want to max out, if you're under 50, you can do 23,000 plus 20% of 100 or 43,000 bucks. If you're over 50, you can do 30,500 plus 20% of 100 or 50,500. It's a lot more than the SEP, right? Another example, right? You make 100K, you have a S Corp over 50. SEP IRA, the max you'll be able to put away is 25K, 25% of 100,000 bucks. If you have a solo 401k, you'd be able to do 30,500 plus 25,000, giving you 55,500. So put away a lot more money, more than double. And that's why the solo 401k, from a contribution standpoint, will out-trump a SEP IRA every day of the week, including Sundays. Employee deferrals can be pre-tax or Roth. Now employer contributions like a SEP can be pre-tax or Roth as well. Contribution deadlines for a solo 401k, it's pretty flexible. If you're a sole proprietor or single member LLC, you can make the contributions up until you file your tax return, your 1040. If you are C or S Corp, your employee deferrals, the 23,000 or 30,500, must be done by 12/31. The profit sharing, the 20 or 25%, well, in this case, 25%, is due when the company files its return, including an extension, whether it's 11/20, 10/65. Talked about the employee deferrals. This is for 2023. So you can still set up a solo 401k in, 24 for the 23 taxable year. You just make sure you haven't filed your tax return for 23 yet. So if you're watching this video and you're still on extension and you're excited about trying to maximize savings and boost your retirement savings and or generate tax deductions for 2023, still an opportunity to do so in 2024, so long as your business or you personally, if you're filing a Schedule C, have not set up and have not filed a final tax return for 2023. The loan feature is another really interesting opportunity, especially as the economy is in a bit of turmoil, high inflation. SEP IRA will not let you borrow $1 from your SEP IRA. You'd have to take a taxable distribution. SEP solo 401k, you can borrow the lesser of $50,000 or 50% of your account value, whatever's less, use it for any purpose. So if you have 100K in your 401k, you can borrow 50. If you have 50, you can borrow 25K. If you have $1 million, you're stuck at 50K. The lowest interest rate you can use is prime as per the Wall Street Journal, which as of May 23rd, 2024 is 8.5%. As interest rates go up or down, that prime rate adjusts as well. The rate is much higher than it was. For example, during COVID, it's 3.25%. But the good news of paying a higher interest rate is the interest is going back to you. It's going to your plan. So if you borrow 50K, you're basically getting an 8.5% rate of return on that money. So look at it that way. Obviously, it's a bigger check you got to write back to the plan. Now, you can pay the loan back weekly, bi-weekly, monthly, quarterly. You just can't go beyond quarterly. You can do multiple loans at one time. And once you start paying the loan back, you can start taking more money. The loan could be used for any purpose: medical bills, mortgage, go on vacation, whatever, buy a car, whatever you want to do. There's no restrictions on how it's used. You just got to make sure you pay it back. Leverage, tax-free leverage. So the solo K is a big friend for real estate investors. Why? Because every real estate investor, every smart one wants to use leverage, right? OPM, other people's money. So if you use leverage with an IRA, so if you put 100K in an IRA and use a non-recourse loan to borrow another 100K, and the reason I say a non-recourse loan is 4975C1B does not let you personally guarantee an obligation of your IRA. So you can't get like a regular recourse mortgage. Non-recourse loan means if you don't pay back, all the IRS can do is take back the asset. They can't go after you personally. So the rules state that only a non-recourse loan can be used. So going back to my example, you put 100K in your IRA, and you borrow 100K non-recourse from a bank, 200K, you buy the asset, the real estate, and you sell it for $100,000 gain. Based on my example, since you use 50-50 debt to equity ratio, approximately 50% of the gains would be subject to the UBIT tax. Now, I say approximately because you'd be able to take into account depreciation, other related deductions. So for simplicity purposes, let's just assume there's no deductions. So $50,000 would be subject to the UBIT tax, which can go as high as 37% once you're above $14,500. So it's a very low income threshold. Very painful tax. It's a 4-letter word for real estate investors. However, under Section 514C9, if a 401k did that same transaction, instead of an IRA, a 401k did the same transaction, you'd be able to avoid UBIT because of this exemption under 514C9 of the tax code. So this is a huge opportunity for real estate investors that want to supercharge their returns and use leverage to buy real estate. The mega Roth, one of my favorites, right? If you're a Rother like me, and I wrote a book, In God We Trust and Roth We Prosper, this is a huge opportunity. The mega backdoor Roth will let you go dollar for dollar up to 69K. No catch up, but up to 69K. SEP IRA only allows you to do profit sharing in Roth. So if you want to go all the way up to 69K in Roth, you're going to have to make $300,000-$400,000. In a solo K, you can make 75, 80K. There's self-employment tax that has to come out, and you can literally just go 69K dollar for dollar in Roth. Okay, there's no catch-ups. At 76.5 should not be there. It's just a 69K, and you can actually keep it in the plan, or you can actually make the after-tax contribution and then literally roll it to a Roth IRA, even without a triggering event, and now have 69K in a Roth IRA. You, of course, don't have to do the full 69. You can do 5,000, 10,000, 50K. Just gives you an opportunity to supercharge your Roth returns. Why is it such a jackpot for Roth? Well, the hardest part about a Roth is getting more Roth money in the Roth. The Roth is the best legal tax shelter out there. It's as good as life insurance, better than the 1031. Why? Because everyone could use it. 1031 is just real estate, folks. Anyone could potentially make Roth contributions. Even if you make more than $240,000, married, filed jointly, excuse me, you can do what's called a backdoor Roth and make an after-tax IRA contribution and then immediately convert it to Roth tax-free. So the hardest part of a Roth is stuffing it with more Roth money. Well, the mega backdoor is a great way to stuff more money in a Roth because you can go dollar for dollar up to 69K. A 401k employee deferral, as I said, is only $23,000 or $30,500 if you're over 50. And then you'd have to do the profit sharing in Roth. you can hit that 69,000 max much quicker, dollar for dollar in the mega backdoor. Now, not all 401ks will let you do the mega backdoor. Most corporate plans will not let you do it. Either their plan docs won't allow you to do it, or if their plan docs will allow you to do it, because of what's called top-heavy ERISA testing or ACP, ADP testing, deferral percentage or contribution percentage, if not enough people are doing the mega backdoor, the plan will fail the test and it's not going to be respected. In a solo K, there's no ERISA testing because it's just, there's no non-owner employees to protect. ERISA doesn't have to protect solo 401k participants because it's only the owners and their spouses, and they're not going to need to protect them from themselves. ERISA protects employees that are non-owners, but because there's no employees that are non-owners or spouses in a solo K, ERISA doesn't apply, and there's no need to do all that testing. Solo K is easy admin. Only if you have more than 250K, you have to file a 5500 EZ. Good news is IRA Financial will do all that for you, so that's not really an issue, but this is one advantage of the SEP. SEP IRA, the IRA custodian does all the reporting, not you. Credit protection, the solo K, the 401k has greater asset credit protection than IRAs. Under the Bankruptcy Act, it's generally unlimited. Most states will grant 401k better protection than IRAs. IRAs under bankruptcy, 2005 Bankruptcy Act, there's exemptions a little bit over $1 million, whereas 401k, it's exempted. And then, as I mentioned, states will generally provide more protection to 401ks and IRAs for asset credit protection. Who wins? Let's get to the fun, right? Solo K or SEP IRA, Mike Tyson, Evander Holyfield without the ear biting. The solo K is going to win pretty much every time. The only time the SEP IRA is going to win is if you're under 50 years old, you make, let's say, $1 million, and you're going to max out. You don't care about the loan. You don't care about leverage for real estate. You're going to hit your 69K, right? Because 20% or 25% of $1 million is more than 69K, so you're capped at 69K. You don't care about the loan, and all you want to do is max out your contributions. Then the SEP's going to work really well for you. I should say SEP IRAs and solo 401ks both could be checkbook control. The one thing with a SEP IRA, if you want pure checkbook control, you need to use an LLC. For a solo 401k, if you want checkbook control, you don't need the LLC. Why? Because as the trustee, you have checkbook control just by being the trustee of the plan. Okay, you don't need the LLC to get to checkbook control. In the IRA, the trustee is the custodian. That's just the way IRAs are set up. 401k, you're the trustee. Generally, you would appoint yourself. You wouldn't appoint a third party. But an individual, the business owner, is the trustee of the plan. So that gives you the checkbook control since you control the bank account. In the IRA world, the IRA custodian is the trustee. So in order for the IRA owner to get checkbook control, that's when you have to use a special purpose LLC to get that checkbook control. Solo K, as I mentioned, has the loan feature, right? It has the mega backdoor. It has the ability to have the catch up if you're over 50. It has the employee deferrals. It also has the exemption to UDFI, the UBIT tax for real estate using leverage. So again, putting it all together, it's really not a close fight. It's really not. The solo K is literally going to win every time. And that's why since EGTRA, the solo 401k has become the most popular plan. And I've written 2 books on the solo K. Here's one of them. Like, I haven't written one on the SEP IRA. I incorporate features of the SEP IRA in my books on self-directed IRAs or SEP or solo Ks, but I don't have a book specifically directed to the mechanics of a SEP IRA. Why? Because there's really no need for it. The only time you're really going to just do the SEP, assuming you're not misinformed by a tax professional, is you're going to max out, you're under 50, you don't care about the catch up, you don't care about employee deferrals, you don't care about the mega backdoor, you don't care about the loan, you don't care about asset credit protection, and you don't care about the UDFI exemption under 514C9, the SEP's going to work great for you. Plus, it will give you easier annual admin because you're not going to have to do anything. Your IRA custodian, whether it's Vanguard or IRA Financial, will handle everything for you. So it works really well for you. I went through the contribution benefits. Obviously, the solo K is going to win every time. The loan option, the solo K is going to win every time. The alternative assets, if you want pure checkbook control, you don't even need the LLC with the solo K because you, as a trustee, have checkbook control. The mega backdoor, I talked about that already, and the UBIT exemption. So the verdict, as I mentioned, solo 401k is going to win almost every time. And, other than the one instance where you're under 50 and you're going to max out, you don't care. But any of the other solo K benefits, otherwise, if you have a SEP IRA now, you can easily roll those funds tax-free into a solo K. You can do that. There's no triggering event. You just go on our website or app, set up a solo K. In fact, the IRS is giving you a $1,500 tax credit to set up a solo K, so long as it includes the auto enrollment feature, which we will make sure it does. And you'll have $500 tax credits over 3 years, equal to $1,500. So they're essentially paying you to set up a plan. And IRA Financial, we take care of everything. We do the 5500 EZ, 1099s. Even if you have UBIT, we'll do the 990T. If you have partnership returns, 1065s. Like, we are a one-stop shop. We will do everything for you. It's one of the benefits of IRA Financials. We're not just going to set up the plan, give you documents with an IRS opinion letter, but we're going to give you all the important consulting, compliance, tax reporting, tax filing, and audit guarantee, audit support that you would hopefully never need. But if you do need, we're here for you. And that's the most important part, I think. So again, why IRA Financial? It's in our name. It speaks for itself. We literally wrote the book on this stuff, and almost 25,000 clients, over 3.4 billion in assets. I don't think there's a reason you'd want to use any other company than IRA Financial for any of your self-directed IRA or 401k needs. But that's obviously your choice. And we have a lot of clients that come to us and say, hey, I didn't realize you guys did this. I want to set up a solo K for you. Can you do it? I have a self-directed IRA, I have a SEP IRA, or I have a solo K at another institution. So absolutely. We'll take over the plan. We'll just amend the plan docs. If you're not IRA, we'll just fund the solo K with the IRA tax-free. The only IRA that cannot fund the 401k is a Roth IRA. A Roth IRA cannot be rolled into a solo K. Otherwise, a pre-tax IRA, pre-tax 401k, a 403b, a 457. So long as you leave your job or you're over the age of 59 and a half, you can do a tax-free rollover into a solo. SEPs can go into solos any time you want. We handle all that. We'll handle the tax-free transfer, handle a new plan. You'll get the new documents, an IRS opinion letter, and of course, VIP white glove treatment to help customize the plan and kind of walk you through all the details. We'll do all the admin, compliance work, and help you on any tax structuring, investment, tax optimization involving your plan. So that's it for today. Thank you again for hanging out with me today. Really important topic, SEPs. There's millions and millions of SEPs out there, and they're super misunderstood. All people, I think, understand is that it's a profit sharing plan, but they don't really get, number one, that there's a solo 401k option that's out there that could be even more tax advantageous. They're just, for whatever reason, I have a SEP, that's all I needed, I'm good, no need for anything else. That's not necessarily the case. The 3 to 5 year rule, they're not aware of. They're also not aware of the Roth options, which is new to the SEP IRA starting last year, 2023. And then a lot of people say, hey, I want to do the solo, but how do I get the money out of the SEP? Is that possible? The answer is yeah, no problem. You can do a tax-free transfer from a SEP to a solo K anytime. Both the SEP and solo can do checkbook control. So you don't have to stay in the IRA world to get checkbook control. Our solo 401k plan docs allow you to have checkbook control and let you do alternative asset investments. This is the last thing I'll say. Not all solo 401ks are the same. If you get one, you can get a plan at Schwab or Vanguard. They may even give it to you for free. But you're probably not going to have a Roth option. You're not going to have the loan feature. You're going to have no alternative asset options, no checkbook control. And I can tell you, you're not going to get any annual tax support from a compliance, reporting, filing standpoint. You're going to be on your own. Okay, so you're going to have to hire a third-party administrator to take care of your plan. We do it all. We're going to set up your plan. We're going to customize it. You get an IRS opinion letter. We'll admin it, record keep it. We will do all tax optimization, tax compliance work, audit guarantee, IRS support, plus, more importantly, any tax filings, any tax reportings. We will do it all for you for one low flat fee without the hassle. So thanks again for watching today's video. I hope you guys enjoyed it. Really fun topic, and look forward to talking to everyone again next week. So definitely, if you're watching this, check out our YouTube channel. If you have not subscribed, please do. It's a great channel. We generally drop 2 to 3 videos a week, 3 podcasts. So lots of great content if you're interested in anything self-directed, whether it's IRAs, 401ks, alternative assets, updates in the law, tax cases, new legislation, anything IRA, 401k, and alternative asset related. This is the primary source on the internet. So definitely subscribe. It's free. I mean, what are you waiting for? That's it. Have a great day and see everyone again soon. Thanks.